In this video, we're going to go over what happens when the accrued expense account on the balance sheet changes and how it affects the three financial statements. So first off, before we begin, recall what accrued expenses actually mean. They are an account on the balance sheet, and the definition here and how it works can get a little tricky, so I want to go over this in some detail. So an accrued expense is an expense that will show up on the income statement and is recognized on the balance sheet. The accrued expense account goes up as a result, but it has not yet been paid out in cash. So this expense account on the balance sheet is up, and you see a corresponding expense for it on the income statement, but it has not yet been paid out in cash. So what that means is that when your accrued expense balance goes up, even though you have an added expense on the income statement, your cash on the balance sheet is actually going to be going up because you're not paying it out in cash immediately. So that is basically the purpose of accrued expenses. Just to give you a quick example, to make this more concrete, let's say that we look at this over the course of 3 months, January, February, and March, and we owe an employee $10,000 in salary for each of these months. And we don't actually pay him in cash at the end of each month. Instead, we pay him in cash at the end of these 3 months. And we owe him $30,000 for this entire quarter. So what would happen here in accounting terms is that these expenses here, the $10,000 in January, February, and then the $10,000 in March, for the income statements for January, February, and March, these would all show up as expenses, as operating expenses on the income statement, and then on the balance sheet, the accrued expense account would go up by $10,000 in each of these months. And then what would happen is after it's gone up by $10,000 each time, then at the end of March, it would finally go down by $30,000, and we would actually pay out the salary in cash. So what would happen then is that the accrued expense account would fall, and then you'd see a corresponding fall on the asset side under cash as well. So that's basically the purpose of accrued expenses. And they occur all the time with real companies because you always have these scenarios where a company hires someone or pays for something, but they don't actually pay for it in cash until the end of a period, until the end of the year, or until next year, or something like that. So you see them all the time with real companies. So let's just go through the three financial statements now. I'm going to enter accrued expenses changes by here. So first we're going to go through an example of an accrual, and then I'm going to show you how a company would actually pay out accrued expenses once they're actually owed in cash. So I'll enter 100 here. So let's go to the income statement first. So when accrued expenses goes up by 100, there has to be a corresponding journal entry here for operating expenses. In this case, we're assuming that they all occur in SG&A. Could go either way on this one, but in any case, the operating expenses are going to go up by 100. You could actually even have COGS here going up by 100 hypothetically, but basically your operating expenses are going to go up by 100, and your operating income, regardless of what happens here, is going to fall by 100 when accrued expenses goes up by 100 here. Because remember, these show up as real expenses on the income statement, but they're just not being paid out in cash yet. So operating income is down by 100, pre-tax income is down by 100, and our net income here, if we assume a 40% tax rate, is down by 60. So now on the cash flow statement, so our net income is down by 60. No other changes on the non-cash add-backs. Accrued expenses is up by 100 now. Remember that a liability going up means that our cash is going to go up, so overall cash flow from operations is up by 40 because our net income was down by 60 and our accrued expenses is up by 100, so overall cash flow from operations is up by 40. No changes to investing or financing activity, so overall cash here is up by 40. So now let's go to the balance sheet. Cash, as we know, is up by 40. No other changes on the asset side, so overall assets here are up by 40. And then on the other side of the balance sheet, accrued expenses are up by 100 because that was the initial question. We know that accrued expenses have gone up by 100 here. We've accrued these expenses now. No other changes to the other liabilities, so overall liabilities are up by 100. And then on shareholders' equity, retained earnings here are down by 60 because our net income from the income statement has fallen by 60 here. So retained earnings are down by 60. Shareholders' equity is down by 60. So liabilities is up by 100. Shareholders' equity is down by 60, so overall liabilities and shareholders' equity here is up by 40. So that's up by 40, and then the asset side is up by 40 as well, and so both sides of the balance sheet balance, and our question is done and answered. So that's how accrued expenses going up by 100 affects the three statements. The most important point to keep in mind here is that when you have something like this, there has to be a corresponding entry to your income statement, and expenses here have to go up by 100 if accrued expenses on the balance sheet are also rising by 100. So I'm just going to go in and delete this entry now. And then the second thing I want to show you is what happens when accrued expenses are actually paid out. Now I have to warn you in advance that this is not 100% supported by the model that we have here, because the way I've set up this model, what's happening here is that the accrued expense account, whenever this one goes up, accrued expenses on balance sheet goes up, and then the operating expenses on the income statement always go up as a result. But the actual payout of accrued expenses in cash, that's not fully supported by this model, so I'm going to have to go in and make some manual edits here to show you what happens. So what happened here is on the income statement, there would actually be no changes. Because remember, we've already recorded these expenses, so it's not like we're going to go in and delete these expenses or undo the expenses or anything like that. So when you pay out accrued expenses in cash, there's actually going to be no changes to the income statement right here. On the cash flow statement, what would happen is that our accrued expense account here would fall by 100. So I'm going to enter negative 100 if we assume a $100 payout here. No other changes. So overall, our cash balance here falls by 100. Because remember, when a liability goes down, our cash account falls. So on the balance sheet, cash and cash equivalents falls by 100. Assets is down by 100. And then on the other side, accrued expenses here would also fall by 100, so it would go from 100 to 0. Both sides are now down by 100, and our balance sheet balances. So that's what would happen when you actually pay out accrued expenses in cash. Again, it's not supported by this model the way it is. This model only supports actually accruing the expenses and recognizing them on the income statement, but that's what would happen if at the end of the period you actually paid out these accrued expenses in cash. So that's a quick overview of how accrued expenses work accounting-wise, why companies actually use them, a real-world example of what would happen, and then how changes to the accrued expense account flow through the three financial statements and how to answer these questions in interviews.